Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are live from our new digital studio. Give you kind of a look at it again real quickly. We're really proud of this, something we worked on for 9 months, so really fun for us all together. Obviously, the same format applies. We're trying to help people improve the possibility of a more successful retirement. And we believe that learning more about retirement and asset planning, retirement planning, and tax planning are really kind of the keys to try to create success in retirement. And so it's a question and answer show. We're going to answer questions. You can send in questions now. So if you think of something, or if we cover something that you want to dig in further on, go ahead and put in a question. Here's the email address at asktom@talkmoneywithtom.com. You can go into the chat and put a question in there. And we often highlight some questions that come from our strategy sessions with our clients that we think are important that everybody should probably hear about too. So that portion has been consistent throughout this show. And of course, part of the education that you can pursue here is just subscribing to our channel. We have over 800 videos currently on the channel. And so you hit that subscribe button, hit the little bell next to it, and that'll get you, notified when we put new content on there. Of course, you can just book an appointment with Ethan and I. There's a link to our website on the channel here, and the book appointment button looks just like that. It's up in the corner, and you hit that, and you can pick a 30-minute, phone call or video appointment with Ethan and I, and we can, more of a custom conversation, things that you might not want to ask on a show like this, you could ask in an appointment, obviously. So really looking forward to being able to, help you with this particular portion here, and hope you get something good out of this. I, of course, always like to start with a summary of what I saw happening with the market this week. Really amazing week altogether. And let me show you a chart here just for starters. So here's the year-to-date S&P 500 chart, and Monday, Tuesday, Wednesday were up. Wednesday was really up. Thursday we took it all back, and today we're kind of down to near the lows of where, at least this morning anyway, near the lows of what we hit back on Monday morning. And so one of the things you might notice if you look closely at this chart is that we're kind of challenging the same low point, more or less, around 4,100-ish on the S&P 500. And so on 24th of February, there's a low point there. That was the invasion date of, for Ukraine. And in the morning, we hit a low there. And then Monday, and then today. And so we're hitting what's called support. That just means that there's people willing to buy at that level. So when the price gets there, they come in and they buy, and the price jumps back up. But one of the problems you'll see is when you keep hitting support over and over again, you can actually dry up that support. I wouldn't be surprised at all to see that happen and have us come down. Next level of support's about 5% lower than where we are right now. And so that is part of the process. More or less what we have happening here is just this giant battle between opposing forces. One group that believes that things are going to be okay and they want to buy at these lower dips, and another group that believes that we're going to head into a recession and need to sell when things run up and such too. So with that in mind, really this week one of the biggest pieces was what was happening with the Federal Reserve. So they met this week. The chairman of the Federal Reserve came out, Chairman Powell, and spoke, talked to the American people, which is kind of interesting to watch, just really about inflation and how they're going to try to fight inflation. And then there was a question and answer session that happened. And I thought the questions were really good this week, this particular time. And of course, Chairman Powell does a really good job of answering those questions. So the overall summary was that they just raised rates another 0.5%. He talked about raising rates, another 0.5% for the next two meetings, June and July meeting, and that they were going to start to sell some of the assets that they had on their balance sheet starting June 1st. So as you probably recall, the Federal Reserve was buying Treasury bonds and buying mortgage bonds to create liquidity. And now they have about $9 trillion worth of those bonds on their balance sheet. And so now they're going to start to sell them or let them expire and fall off, which would create a more restrictive monetary environment, all right? So that's what they were doing. And then in the commentary, he was saying that he felt that the economy was very strong, the job market was strong, The consumer households were very, very sound right now, and businesses were very sound financially and spending and all these different things that they're looking at. And they felt that they could push down on the economy by raising interest rates and letting these bonds fall off the balance sheet, and the economy would not kick into a recession. They should be able to push down, get inflation down without causing a recession, right? And so that it was very positive. The market moved up very strongly on that day, over a little about almost 3% basically for the S&P 500, for example. And one of the big catalysts was that they basically said that they weren't going to do a 0.75% increase at these future meetings. It wasn't on the table at this point in time. Obviously, things can change, and we'll see what happens there. But that's what really seemed to get things rolling on that particular day. So that was all good. It seemed very clear. I do like the clarity that we're starting to see. We now know what's going to happen with the balance sheet and all these things. But the question and answer period was excellent, and there was one question I thought was very interesting, and that was that Powell had been talking about trying to lower the demand to meet the supply to kind of create this balance that would then create a lower inflationary environment. And so the question was, what happens if the supply doesn't come up or even falls down further? For example, because China, which is kind of a huge part of our supply chain, continues to lock down, or the Ukraine war continues to create problems in the supply chain. What happens with that? If the supply starts to come down or doesn't meet you, are you still going to push demand and push interest rates basically up to make that match up with supply? And if you do that, will that cause a recession? He didn't really answer it. It was sort of I thought it was sort of like a political answer. And the reason you can't really answer that is because it's probably yes. And that's the one big danger right now, is that supply doesn't come to meet them. If you're going to decrease demand, the supply isn't coming up to meet, then that could be difficult to deal with. And more importantly, the Federal Reserve doesn't really influence supply. There's outside influences. They can lower people's wants and demands, but they can't really move the supply side. So it's very interesting. They spent a lot of time talking about jobs and job openings as being a big problem. There's 11.6 million jobs open right now, which is an all-time record. Again, seems like every time they report that number is at a new high. And what happens then is what's called wage cycle inflation. So, so many open jobs, nobody's taking those jobs. They're desperate to get the people in, so they start paying more, offering more on these new jobs. Of course, that maybe works. People come into work, and then the companies have to charge more because they're paying more for the labor. And of course, now we're all out purchasing these things, and those things get more expensive, and the labor comes back and says, hey, we need more money. And it's this upward cycle. It's what happened in the 1970s. So what they're really trying to do is drive down the number of open jobs, ultimately by slowing down the economy. So, if there's 400 people that want to fly in an airplane, and the airline can't get pilots, and they can only get one pilot that can fly 200 people, that's a problem. So they can't get two pilots, which is what they need. They only get one. And so what are they going to do? Well, they're going to raise the prices on those plane tickets until there's only 200 people that really want to pay that much for a flight. And so you have to then try to drive down demand, right? So maybe there's only 300 people or 200 people that actually want to fly because the economic situation isn't as good as it used to be. And you also need to get that supply chain up, which in that case means more pilots, right? And so that's the big issue. It's really interesting to see how this is going to play out as far as that goes. So I think it's going to take some time here to figure out who's right in this particular battle. Are we going to have a scenario where supply does increase, the demand dissipates enough, we get back into a better band for inflation without kicking us into a recession? Or is the Federal Reserve going to have to push so hard that the only way they can get inflation down is by causing a recession? It's very important to the stock market. The average rate of return in a downturn without a recession is 15%, which is right around where we are now. The average rate of return in a recessionary situation is negative 36%. So this is where we're at right now, just trying to figure out, what's going to happen here, and something we're going to be watching. I will say, I think it's much more important right now to watch the supply side. We have a very clear picture of what's going to happen, I think, on the Federal Reserve's path, right? And that can change, but at least they spelled it out very well. What we don't have a clear picture of is what's going to happen on the supply side. How's China going to deal with these lockdowns? What's going to happen in Russia, Ukraine, and other situations that might come at us. So, looking at shipping and shipping rates and trucking rates and all these things. And then also looking at whether there's a spread. We've been buying goods mostly. We haven't been doing services as much. Does services start to pick up, and does that start to allow some, lower prices, or at least less gains in prices on goods? And so, those are things that we want to watch for as well. So there is one other key kind of interesting piece here. This is a American Association of Individuals Investors, AAII, does a survey regular basis since 1987, and they ask the people, how many of you think the market is going to be higher in 6 months? And so if you go back to 1987, there's only been 4 other times where the number of people that said they thought it was going to be higher in 6 months was less than 20%. So the last 2 weeks, we've had less than 20%, just like these other 4 situations. It's only 5 times since 1987 has this happened. And I know this seems kind of weird if you think about it. Oh, everybody thinks the market is going to go down. Maybe I shouldn't be in the market. Well, that's true to a certain point until everybody gets onto one side in too extreme of a situation, because it only leaves the buyers to come back in and move. And if you look what happened in these other 4 situations, it was 1988, 2 times in 1990, and 1 time in 2016. If you look out to the 1-year chart here, 100% of the time the market was up a year later. The average rate of return was much higher than the average rate of return for the S&P. It was at 23.51%. And so these scenarios are something to watch for. The other thing is we've never had 3 weeks in a row below 20%. So I think next week will be interesting to see what happens with this particular survey as far as that goes. But keep in mind that, if you're nervous, lots of people are nervous, and sometimes enough people get nervous, that's when it turns the other way and starts to come back up. So let's see what happens. I do feel like we'll probably have some continuation to the downside, but we might start to see some pop to the upside because there's really nobody left to sell at some point in time. So anyway, that's what's happening with the market so far this week, in my opinion. It's still a time to be cautious, but also a time to kind of hang in there and really see what's going to play out and how this is going to work as far as that goes. Mainly because once things do start moving, they can go really, really fast to the upside. I mean, we saw just a super powerful move on Wednesday, for example. So if you're going to, sell everything and then try to jump back in, you could easily miss out on some of these really big up days if they happen. So better to have a well-diversified portfolio, hang in there, wait for things to kind of play out and settle out, because everybody's running around like they know what's going to happen, but we don't. So we have to kind of wait and see. So anyway, look forward to talking to you next week for what I see then. Thank you very much. All right, Ethan. I know we have some questions that came in. We have some things from the clients too. So let's kick into that.
So let's start with a Fed question for the first question. How does the Fed control the job market? Since the Fed only has a limited amount of tools, so how do they specifically slow the demand for jobs?
Yeah, I mean, let's review what those tools are first of all. And there's lots of little ones, but the 3 biggies that come to mind that I think are important. Number one, the Fed talks about raising interest rates, which is what they've done first. That was the first thing they did. They started that in November, and they really aggressively talked, and so it got more aggressive from November through, really now, about raising interest rates, fighting inflation, slowing down the economy. They say the words that scare the stock market, but certainly, but they also say the words that make the bond market react. And so now all of a sudden, mortgage rates went from below 3% to above 5%. Housing is a huge component of the economy. So, if you slow down housing, right, Well, there's a bunch of jobs that might not be open anymore because new people, in construction aren't adding, new people. So that talk is first. The second, thing that they really have done here is to raise rates. This is their standard scenario. Rates were basically at 0%. And now they've raised them up, twice, 1/4%, and now, 0.5% in this last meeting. And obviously, when you raise rates, it makes borrowing costs higher. Interestingly enough, there's probably a psychological component of that also, just because businesses look at that and say, wow, here's the trend. Things are going to be going up here in terms of rates. When they've done that in the past, the economy does slow down. So if I'm a business person thinking about future investment, I might buy this big machine. Maybe I won't until I see how things play out here, because if the economy cuts down, I'm going to end up with this big machine or whatever it is, or these people that I'm hiring, right? And so maybe I won't hire as many people right now because I'm not sure about the future, yeah? And then the other thing that they're doing, and this one's actually kind of interesting, and that's, of course, letting bonds fall off of their balance sheet, or actually selling some of those bonds. It's what's called quantitative tightening. So quantitative easing is when they were buying those bonds, and now quantitative tightening, they're letting them go. And it's a little bit controversial as to what that really means. How much impact does that have? We have great data on raising interest rates, definitely going back forever. Quantitative easing and tightening has really started with the 2008 downturn. So we've only had a little while to really see how that plays out. But that would be another thing that they're using. All of these, in essence, are trying to slow down the economy and make businesses think about not putting up new jobs, in essence, because they're just nervous about what the demand will be for their products, going forward. So.
Yeah, but those still seem quite blunt. It's not very targeted. It seems it kind of hits everything, but not really specifies.
Yeah, exactly. So, if you're in a business that isn't really hiring, and you're still going to get whacked on the head and slowed down, because maybe you're already kind of slow, and that you're going to be even slower theoretically as they go through this process. Yeah, they don't have kind of surgical techniques to come into certain industries and deal with it. And some job openings are open because there's nobody to take those jobs. We don't have enough Americans that are trained in that particular area. And even if you try to slow down the economy, there's still so much demand for those people because there's nobody here to do it. I know that used to be true with software engineering for a long time. I don't know if that's true now or not, but nonetheless, so that's why you're exactly right. It's sort of this blunt thing. It's a big sledgehammer. It hits all businesses, whether they're going fast or going slow. And so it can be, it's something to pay attention to when they start to raise rates. We are in the infancy, though. We're just beginning. So you got to be careful with being too forward thinking as to what might happen. But that's the Fed's methodology, and they did speak about that a lot. They talked about getting job listings down as a good thing. Obviously, usually you want those job listings. That's what in a recession you want, more job listings. But then everything has a too good and too bad scenario. You want this kind of middle ground, and so right now there's too many job listings, and that's going to create this wage inflation spiral that they're worried about. So yeah, it's good. It's a good question. All right, what else we have?
So our next question is not really a question, but a concept that we have to go over a lot in our client meetings is why trying to lose less is important.
Yeah, it's sort of a situation where, as a client, you don't want to lose anything. In an ideal world, you just make 10% every year and never have a loss. And there were periods of time you could do that at the banks, right, when interest rates were really high and you could buy a 10-year CD. But obviously that's not true today. Even with these higher interest rates, you can't do that. And so when you're in the stock market, you're going up and down to get that 10% or whatever you might be getting. And so there's some risk of loss there. And so one of the points that I try to make to people is that, anything that we can do to lose a little bit less than the market and still be pretty prepared for the upturn. Because there's two parts. There's lose less and there's recover faster. Those are both things that I focus on. And you try to make some adjustments to portfolio to lose less while you're still keeping your eye on the recovery, the possible recovery. So, for example, I'll really focus on what's happening in these up days, because those are the things I think might go up when things go up again and really start to recover. And so, but there is some math behind this that's important to understand. So let me kind of share this little chart here that we made. So if you have a $100,000 investment and you have different levels of downturn, so let's say you lose 20%, you now have 80,000, right? So I have 80,000, I want to get back to 100. I have to make $20,000, right? Which comes out to a recovery return of 25%. So it's just simple math, but it makes a difference. So if you look at now, somebody else loses 33%, right? So now they have $66,700, give or take. They have to make 50% to get back to 100,000. Somebody who loses a 50% now has to make a 100% rate of return to get back to where they were at 100,000. So the less we lose, because there's kind of like this almost compounding factor there, the recovery return is going to be much more manageable as far as that goes. So you have to be careful if you're trying to really, again, you have to bridge two pieces here: how much you come down and how fast you recover. Because if you get out all of a sudden in a panic and the market bounces back up, you just miss the recovery return. And then you get back in and it's slowly going up, and it might take you a heck of a lot longer. So, there are periods of time, I think, where you probably want to get defensive as far as that goes, but they're pretty infrequent. We've only had, 4 massive downturns since the 70s, the 73 downturn, the 2000 downturn, the 2008 downturn, and the 2020 downturn, right? Those are the ones, if you could go back and get out halfway down, you'd be pretty darn happy, even if you didn't get back in at a perfect time. But most of the other times, you would have been better off just hanging in there and using other strategies. And that's my outlook. I'm really looking at the big downturns, and that's what I watch for. And I try to use other strategies like rebalancing, asset allocation, being in a couple target pieces that I try to pick to try to do better in certain situations, right? But this downturn pieces are really important, and it's very important to try to lose less on the downside, even if it's just a little, as long as you're positioned for that upside recovery, because that's where you get your money back. The market has gone up over time, no doubt. I mean, you pick all those big downturns. 73, market's way higher. 2000, huge downturn. Hit us here in Silicon Valley. I still wish I would have bought at the top because I'd still have money. I wish I'd have bought at the top in 2008 because I still would have made money. If I'd have bought at the top in 220, it's higher now, right? So the market comes back, at least so far, and so. And that's the key issue, is just to kind of have that overall outlook and understand kind of what's happening in the long term too. But generally speaking, losing less is a really, really good idea. And ultimately, up to those big downturns, you want to just try to structure the portfolio for something that you think is going to recover really well. That's what I do, but might fall a little bit less. I feel like our current portfolio has done a really good job with that so far this year. So, that's what we're trying to accomplish there. So, yeah, it's a good question. It's a very, very interesting area.
So our next question is a blended family kind of question. So I'm getting married soon. This is my second marriage, and my partner and me both have our kids from previous marriage. Should we be combining our finances, and what are some pitfalls to avoid?
Yeah, we run across this all the time. Lots of times. Lots of families, second marriages for a variety of reasons, divorces, widows and such like that. And so there's two separate families. I mean, what do you think? I mean, give me some of your ideas as to, how you might handle that.
Yeah, so it's kind of like merging two businesses into one. And so each has their own asset pool. They have their own, kind of traditions, their own ideas in finance, and you're combining them into a new kind of like new one. And so you have to be open. You want to communicate with your partner. You don't want to hide anything from them. And you got to treat everyone kind of on equal terms. And so there's kind of two things you want to think about. It is the now, your medical, who's paying for education, kind of like that short-term futures and that your lifetime. And then you also have the estate planning. So how are you going to make sure that, everyone gets their fair share of your estate in the right way? And so one thing to start thinking about, if you're pre-marriage, is it worthwhile to get a prenup? Or do you want to have it so my partner would get X amount of money while the rest goes to my children? Also, any kind of life insurance or any kind of policies like driver's insurance or car insurance, house insurance, or umbrella insurance, is everyone that's going to be in your household on their benefactors or under that insurance to protect them? Because a lot of times we forget about these things, and my child's not on my healthcare anymore, but is it on my spouse's healthcare or my old ex-spouse's healthcare, or where is this going to be? How are they going to get paid for? And so you have to kind of combine that too. And I would start with a new financial plan. Honestly, you're starting over again with this person. A new financial plan kind of brings out everything into the open, and then you also have to manage the estate. So a new will would be pretty important, so you know where everything goes. And then one thing that happens is a lot of times you want to take care of your spouse, but you also want all your assets not to go to your spouse, but to your children. And so how do I set that up? And so the way a lot of people do that is with a qualified terminal interest property trust, so a QTIP. And so essentially the idea is your spouse has access to the income, and then for any certain expenses that they would need, so like medical, maybe education, or just general maintaining of standard of living expenses, they could access the money. But then everything else, once they pass away, goes to your children. And so that's a really cool way to have best of both worlds while still keeping control after you're gone.
Yeah, I've been through this a lot. I'll discuss a couple soft areas, that aren't always financial, because it's different. And you're the only one that's going to know where you're at with this type of situation. So I see some families where it's really important that it's spelled out. If it's not spelled out, it creates all this consternation. And, you're getting remarried or what have you, and you want the whole group to be happy in the end. And so sometimes really getting organized and spelling it out and making sure that everybody understands, well, you're still going to get this money, and you're still going to get this money, that type of thing. And so that there's, no bad feelings when you have family gatherings and different things along those lines. And so I've seen, where each person will have, their own investments, they'll have their own savings account, and then they have one joint account, and they each put money into that joint account in order to kind of pay the bills, and everything stays completely separated. I've seen other situations, again, this is where you have to determine, kind of where your family is, where things get completely combined together over time, just because, the family is much more of a single family at some point in time. And that's more of almost like an emotional thing more than a financial thing. And so you want your financial situation to match what's actually happening in that family and how that family is being structured together. And so is that Q-tips? Is that, what's the trust called? Not the Q-tip trust. Oh, the prenup. Sorry, just skip that word. And, all these things that can be done. And those are all tools, but you do need to look at the family structure, which only you know, and how that's going to work and how that's going to play out. And you also need to assume that there could be some consternation within the family if you don't spell it out correctly. And so it's just like a business merger. There's the financial aspects of that business merger, and then there's the more soft aspects. What's the cultural situation like with one company and another? How is this group of employees, otherwise known as your kids, going to associate with this other group of employees, otherwise known as their kids? And, so how do you make that come together as one family? And so I do think that the financial portion could be one of the foundations of that to kind of help that along. So it's a really interesting area. We run across it quite frequently. I've seen it done a lot of different ways, and I would say that the difference between one way and another has to do with the difference of where that family is as far as how cohesive they are as one unit or not, right? And that can change over time. And you want to evolve your financial thought process over time as your family situation changes, right? And how close they get together and those types of things. So it's a good question.
Would you say like having open communication between the spouses is really important for kind of like doing this?
Oh, yeah, exactly. And that I see that mostly. That seems to work pretty well, and I see most of them doing that. It really is that communication with the kids, and that can be tough. Only because some people don't like to have their kids involved in their finances. Some people do. Everybody's different there. And so, just trying to figure out what's going to work there, because that's usually where the real problems end up happening. One person passes away, and that person's kids are arguing with the surviving spouse over the money, and the other kids are getting involved, and we've seen some of those situations too. And that's just where it wasn't communicated properly, it wasn't spelled out properly, it wasn't what those kids wanted. It can be difficult, right? Because every single person has a different outlook on what they want, and so you're going to have two kids with two different ideas on how this should work. But nonetheless, you try really hard to get that, and that is communication is an aspect of that. That's for sure.
So our next question is, what is the double step-up basis? I live in California, and I keep hearing this term.
Yeah, that sounds good, huh? Double step up. I like it. So just to be clear, a step up is when somebody passes away, you get to step up the cost basis of that particular investment to current value. So if I have a stock that I bought at $10, it's now worth $100, and somebody passes away, you can step that up to $100. So you had to sell it, you would have no gain, right? And so tax-free sale at that point. Well, in a community property state, you can step up the entire value of that stock. In a non-community property state, you can only step up half. So if I had $10 stock that was now worth $100, I could move half the shares up to $100 a share on the cost basis. The other half, my half, let's say, if my spouse passed away, doesn't get to move up, right? So California's community property state, so we normally see the full amount move up, and so they call that a double step up, which is kind of cool. So anyway, it depends on where you're at, how you have things structured to be able to accomplish that. It's actually a really big deal here, mainly because of housing. So a couple buys a house a long time ago, one person passes away, the house is worth a lot more, and then the whole thing gets stepped up. If the other spouse wants to sell, it'll save a lot of taxes.
Yeah, and so it's kind of important because when you think about it, if you're only stepping up half that basis, it kind of becomes really awkward when you sell a house. So like say you have $500,000, you bought in for $500,000, the house is $2 million, and only half of that gets stepped up.
Yeah.
So your basis is still $1.5 million, and the house is worth $2 million, and so you still have that $500,000 gain.
Yeah.
And so that gets it gets awkward too, because then you start to lose your exempt, your $500,000 exempt when you sell your primary resident. And so this is nice for community property states, which there are 9 of, while other states are common law. And so it really depends on it's a state by state basis.
Yeah. That sounds good. All right. What else do we have?
So you talked about how the market could recover towards the tail end of the year.
Yeah.
What investments would you say would do best? Because, clean energy did really well in that recovery, that pandemic recovery.
Yep.
What investments would you look for?
Yeah. Okay. So really simply, the thing that I'm looking for is the same thing I was kind of looking for in 2020. I was looking for, what's falling less, okay? And more importantly, on those up days, when the market jumps up, even if it's in a downward motion market altogether, sometimes you get these big up days. What's going up? So we've had the time frames I'm looking at right now are the 16th of March to the 29th of March, the 19th of April, and this Wednesday, the 4th of May. Those are the bigger up periods that we've had since this downturn, kind of started really in the, early this year. And look at what's doing well there. And what you're seeing doing well, in my opinion, in a generic sense, are companies that have great cash flow, lots of free cash flow, and are super strong names, and have relatively reasonable PE ratios. and they actually have earnings, those type of things. So, because oftentimes what you'll see is that, things that got beaten down the most will come up a bunch. But in this particular environment, because there's a lot of uncertainty, I don't think those things that did super well in 2020 that have been beaten down so much this year are going to be our leaders out of this downturn, mainly because they, as a group, clean energy is a good example, which I really like, but it doesn't have massive cash flows. It's still kind of an infancy-ish type investment arena. Oftentimes those companies have very high PE ratios and those types of things. That's more of a later stage. And actually, even in 2020, clean energy was a later stage thing. What really took off at the very beginning, Microsoft and Apple and those types of things that people feel like they can trust, will be the first thing. So if we are going to have a recovery by the end of the year, that's not that far away. I think we'll still be in an early stage of a recovery, and things that are like the Microsofts and Apples of the world that people trust, that have good cash flow, that have relatively reasonable PE ratios, will be the first stage jumps. And if you look at what happened in 2020, it was really not until the summer of 2020 where we started to see things like clean energy take off, and things that had higher PE multiples, because you do get this frothiness. You go back to 2000, it was the same thing. The original move were these big companies that did very well. At the end, it was these companies that didn't even have a product. Bingo.com, which gained from $1 to $9, and crazy stuff like that we saw in that time frame. So I think by the end of this year, you're going to see those type of companies moving, and that's certainly what we've seen moving in this time frame. Semiconductors have done well in those time frames. Big tech stocks have done well in those time frames. Big retailers, Home Depots and Costco's and Targets and Visa has done well in those time frames too. So you kind of look at some of those. Again, all these are pretty good names, pretty good stocks. I think that's where I'd start if I was looking for a recovery towards the end of this year. It's just things that are really, doing well in a financial sense. They can also absorb any, if you're wrong and the recovery doesn't happen when you think, they can absorb more of that. I mentioned this before, but a lot of those big companies, when they come down, it's sort of like pushing a beach ball underwater, right? You can keep it down there for a while, but once that thing gets let go, it goes up, woof, and it comes back up to a more normal valuation for a company like that has that kind of growth pattern and those types of things too. So anyway, that's what I'm seeing. That's what I'd be looking at, is those type of stocks. That's traditional. I mean, those are the things that go at the beginning of all recoveries. So I happen to like the Cathie Wood investments as a whole, but I think that's more like a 5-year outlook. You buy those things because that's the future. She's buying the future for the most part. And, we've already had a huge run and a massive downturn. There's so much psychological damage. I mean, I don't see the overall investing world jumping into these things that have been beaten down that much right away, because there'll be a lot of uncertainties. There'll be a lot of people that don't believe the recovery is happening. That's certainly what happened in 2020 for the first, from April through July of that 2020 recovery. Nobody believed it was going up. Everybody kept talking about it's going to come back down, But the things that were going up were these kind of solid things. And then eventually it became the ARC investments. It became the clean energy. It became innovative technology, genomics, you name it, those types of things. And it was really fun. It was a really exciting run at the end of 2020 and the very beginning of 2021. I don't see those things taking off this year. We've certainly seen them move once in a while. One day, big jump, and then they come back down. So there's just not enough belief right yet in the overall scenario to go out and take that kind of risk.
So it's a good time to acquire kind of quality companies at a discount in a downturn.
Yep. That's what I'm doing personally. In our model, we're doing it also. At Microsoft and Apple in our model, we've been acquiring those pieces at a time. We're acquiring semiconductors, which I really like, just because I think, AMD had a 71% increase of their revenue year over year. That's an amazing number to me. And I know that the market is looking forward, still doesn't believe semiconductors will do well because semiconductors tend to cycle, for example. And so, they're still down for the year. But I think the world has changed in the area of semiconductors. It's not just PC sales anymore. It's all kinds of products that I think will continue to have demand for. So, we'll see how that plays out. But, yeah, I think it is a good time to accumulate some of these big names.
So our next question is a planning question. How do I account for health in my retirement planning?
Yeah, I kind of divide health into two pieces. One, just I guess I'd call the normal health type things. Dentistry, which is often not covered, hearing aids, which is often not covered, all the deductibles that you pay for every prescription, and the little $10, $40 things, can really add up over a lifetime. It's amazing how much you can pay for that, and of course, the cost of your Medicare if you're over 65, or the the insurance that you're paying if you're retired before that, is that's all part of the kind of overall outflow budget. We account for dentistry and hearing aids specifically in the plan. We break those out just because they're kind of bigger ticket items, and that's something to plan for. So that's one component of health as far as that goes. The other side is really just long-term care, right? Totally different deal. Can be really expensive. Massive amounts of money, $5,000 to $15,000 a month can be going out for different levels of care, and so then it becomes an issue of testing that out inside your financial plan and saying, okay, let's pick a time where somebody ends up in long-term care. They end up in a certain period of time, and they spend a certain amount of money per year. What happens? Run the Monte Carlo simulation. Oh man, it falls apart, and it goes to unacceptable probability of success levels. Then we need to look at long-term care insurance to kind of try to hedge that bet, or we put all that in. Plan's still successful, still has a good probability of success. Basically, somebody's built up enough capital to be able to handle that type of scenario. And so then maybe they don't need long-term care insurance, but the irony is those people can also afford it. So, that becomes more of a personal choice. So that's kind of how we handle healthcare. Two different looks at it depending on, the situation. Long-term care is just such a big outflow. It kind of needs to be separated out and looked at it. And it can be insured, at least a part of it. And so that's important. And then all these normal things, we basically just put into the overall lifestyle bucket in terms of, what they might be spending there. So.
Yeah, and if you're looking at long-term care policies, kind of that sweet spot is your late 50s to early 60s, where it's kind of a balancing act because you don't want to be paying premiums too long that you're putting more money in before what you're getting out, versus if you apply too late, you might get denied, you're not healthy enough, or the premiums are just too expensive that you can't afford the long-term care that you need. And so you have to find that little sweet spot too.
Yeah, I agree with you. I think one of the keys there is just the fact of, being able to qualify for the long-term care at some reasonable cost. And so, every year that goes by could be a year that you end up with some type of medical situation where, in long-term care, they're mainly concerned about your mind. I mean, because that's where the money goes. If you have a cardiac event, probably won't affect your long-term care insurance outlook, in terms of being able to get that, because, people don't. That's more of a life insurance question, right? So they're more concerned with the cardiac event because that could be something that kills you. Whereas if you start to have dementia issues and things along those lines, those are the ones that end up in long-term care more often for longer periods of time, just because even if you have a spouse or a family at home, it can be really difficult to handle that person in the home by themselves. So then we either need help in the home or in some facility as far as that goes. And so, that's the big advantage of the 50s and 60s too, is because not many people are exhibiting, mental capacity issues at those ages, where if you wait till 70 or 80, you could be, right?
Yeah.
And so that's the key issue there.
Yeah, and sometimes you get a long-term care policy that's kind of standalone, or you can get kind of like these life insurances that are whole life, universal life with these kind of riders for long-term care.
Right.
And so the nice thing about those is whatever premiums are paid in, at least at the end, you have a death benefit. And so with long-term care policies, just they're standalone, there's no death benefit. So if something happens and you don't use the policy, it kind of goes away.
Yeah, those are really popular. I think they've got some benefits as far as that goes. Still a good idea to do those a little bit earlier because you got to qualify for those too.
Yep.
So, yeah. Anyway, really good question. End of the show. We made it. I think we had no technical difficulties today, which is great. And really enjoyed the show today. I think there's some great subjects that we covered. Again, you can subscribe to the channel just by hitting the subscribe button. Let us know. And hit the little bell, and you'll be able to find out. When we get new content posted. You can book an appointment if you'd like. Go to our website, hit the book appointment button. Be happy to meet with you and such too. So really appreciate those of you that joined us today. Really looking forward to next week. Ethan won't be here next week, so we're going to have Marie come in next week. That'll be really interesting to see how this plays out. So looking forward to talking to you next week. Thank you very much.